The average American carries over $6,000 in credit card debt, paying interest rates that would have been illegal for most of recorded human history. But here is what almost nobody tells you. The people who invented compound interest, the ancient Babylonians, also invented strict rules to stop it from destroying ordinary people. Those rules were eventually buried. Today, we dig them back up, because what they knew 3,000 years ago could change everything about how you build wealth in 2024. Picture the city of Babylon in 2000 BC. Not ruins, not desert silence. A roaring metropolis of 200,000 people, the largest city on earth, sitting between the Tigris and Euphrates rivers in what is now modern Iraq. The streets smelled of cedar wood and river mud. Merchants moved silver ingots through crowded bazaars. Scribes hunched over wet clay tablets in counting houses lit by oil lamps, pressing cuneiform symbols into the soft surface with a reed stylus before the clay hardened into a permanent financial record. These were not primitive people guessing at economics. These were sophisticated financiers. Archaeologists have recovered tens of thousands of these clay tablets, and a startling number of them are loan contracts, interest calculations, and business partnerships. In the city's towering temples, priests managed grain deposits for thousands of citizens, issuing clay receipts and charging structured interest on loans of silver and barley. The Temple of Marduk was, in every meaningful sense, the world's first central bank. And right at the center of this financial ecosystem sat a concept that would eventually reach your bank statement, your mortgage, and your retirement account. Compound interest. The Babylonians did not stumble onto it. They engineered it, deliberately, mathematically, and with a set of rules attached that the modern financial industry quietly left behind. Let us talk about what the Babylonians actually knew, and how they knew it. Principle 1. Interest grows like a living thing. Respect it. The Babylonian word for interest was mash, the same word they used for a newborn calf. The metaphor was intentional. Interest was not a fee. It was a living thing that reproduced. When you borrowed silver in Babylon and agreed to mash, you were agreeing that your debt would give birth to more debt over time. The standard annual interest rate on silver loans was 20%. On grain loans, it was 33%. These numbers sound alarming by modern standards, until you understand that Babylonian merchants applied these rates with extraordinary precision. Clay tablets recovered from the city of Sippar, dated to approximately 1900 BC, show multi-year compound interest calculations accurate to fractions of a shekel. These scribes were not estimating. They were computing. The mathematical tablet known as Plimpton 322, now held at Columbia University, demonstrates that Babylonian mathematicians understood exponential growth at a level that would not reappear in Western Europe for another 2,000 years. Principle 2. Time is the most valuable commodity, not silver. Babylonian loan contracts consistently emphasized the start date with extreme precision. The moment the clay was sealed, the clock began. A merchant named Dumuzi Gamil, whose loan tablets were found in the ruins of Ur, dated to around 1790 BC, structured his lending business around a single insight. The borrower who starts repaying early keeps wealth. The borrower who delays loses it entirely to compounding. Dumuzi Gamil's tablets show he lent silver to junior merchants at 20% annually, but offered structured early repayment discounts, essentially the ancient equivalent of paying extra on your principal today. He grew fabulously wealthy. His borrowers who repaid early also prospered. Those who delayed often surrendered land, livestock, and eventually family members as debt collateral. Principle 3. Hammurabi's rate cap. The rule that disappeared. In approximately 1754 BC, King Hammurabi of Babylon inscribed his famous legal code onto a 7-foot-tall black diorite stele, today housed in the Louvre in Paris. Among the 282 laws governing everything from murder to property rights sit laws 89 through 100, which deal exclusively with debt and interest. These laws are breathtaking in their specificity. Law 89 caps interest on silver loans at 20% per year. Law 91 caps grain loan interest at 33%. More remarkably, Law 48 states that if a borrower's crops fail due to drought or flood, interest does not accrue that year. Not reduced. Eliminated. Hammurabi built a force majeure clause into compound interest law 4,000 years before the phrase existed in English. Modern American mortgage contracts do not contain this protection. Your credit card agreement certainly does not. Principle 4. The tablet does not lie. Transparency is sacred. Every single Babylonian loan was recorded in duplicate clay tablets sealed inside a clay envelope, with witnesses named and dated. Both lender and borrower held copies. The accounting was public, verifiable, and tamper-evident once the clay dried. If a lender tried to claim more interest than the tablet recorded, the borrower could crack open the envelope and prove the original terms in front of a magistrate. This was not idealism. It was practical financial architecture. The Babylonians understood that compound interest only functions fairly when both parties share perfect information about the terms from day one. That principle, radical transparency in lending contracts, is the one the modern credit industry has most aggressively resisted. So what do we do with all of this? You are not a merchant in ancient Sippar. You are not sealing clay tablets. But the mathematics of compound interest has not changed by a single decimal point in 3,000 years. What has changed is who it is working for. Right now in America, compound interest is simultaneously the most powerful wealth-building tool available to ordinary people and the most effective wealth extraction mechanism banks have ever devised. The difference between which side of that equation you land on comes down to 4 factors the Babylonians identified and codified millennia ago: rate, time, transparency, and control. Here are 5 action steps you can take this week, drawn directly from Babylonian financial principles. Action step 1. Run your own compound interest audit. By Sunday, pull every account you hold: savings, checking, credit cards, auto loans, student loans. Write down the interest rate next to each one. Hammurabi capped lending rates by law because he understood that above certain thresholds, compound interest becomes mathematically inescapable. If you are carrying credit card debt above 20% APR, and the national average right now is 27%, you are in territory that would have been illegal in ancient Babylon. That is your first target. Action step 2. Make compound interest. Your servant in your 401k. This pay period. The Babylonian insight that time matters more than silver applies directly to your retirement account. If your employer offers a 401k match and you are not contributing enough to capture the full match, you are refusing free silver, the ancient equivalent of turning down a lender who says the first year of interest is on him. Even increasing your contribution by 1% this pay period in an S&P 500 index fund averaging historical returns of roughly 10% annually can add tens of thousands of dollars to your balance over a 30-year career through compounding alone. The Babylonians called this principle, "Let your silver work while you sleep." Action step 3. Open a high-yield savings account if you have not, this week. Traditional savings accounts at major U.S. banks currently pay between 0.01 and 0.5% interest. High-yield savings accounts at FDIC-insured online banks are paying between 4.5 and 5.3% as of 2024. That gap is not small. On a $10,000 emergency fund, the difference between 0.01% and 5% compounded monthly is nearly $500 per year, every year, for doing nothing except moving the money. The Babylonian scribes understood that idle silver in the wrong hands earns nothing. Put your silver in the right temple. Action Step 4. Demand Hammurabi-level transparency from every lender. Before you sign any loan document, mortgage, auto, personal, student, calculate the total interest you will pay over the full term, not just the monthly payment. Lenders present monthly figures precisely because the compounded total is psychologically harder to accept. A $35,000 auto loan at 7.5% over 72 months costs you over $8,500 in interest. A 30-year mortgage at 7% on a $400,000 home costs you over $558,000 in total interest payments. Crack open the clay tablet. See the real numbers before the seal dries. Action Step 5. Automate early. Because Dumuzi Gamil was right. Set up automatic extra principal payments on any high-interest debt you carry. Even an extra $50 per month on a credit card balance eliminates months of compound interest accumulation. The Babylonian merchant who started repaying on day one kept his land. The one who waited lost everything. Automation removes the willpower variable entirely. The clay tablet does not negotiate. Neither should your payment schedule. 3,000 years ago, a scribe in Babylon pressed a reed into wet clay and recorded a loan with a compound interest calculation so precise it would satisfy a modern actuary. He also pressed in the rules, the caps, the protections, the transparency requirements that were supposed to make the whole system fair. Some of those rules survived into the Code of Hammurabi. Most of them did not survive into your credit card agreement, but you now know they existed. And knowing the original rules changes how you play the game. Here is my question for you, and I read every comment. Which ancient civilization should we investigate next? The Romans had a banking crisis that collapsed an empire. The ancient Chinese invented paper money 800 years before Europe. The Venetians built the first modern bond market in the middle of the Black Death. Tell me below which story you want next. If this video shifted your perspective on money even slightly, subscribe to Wealth of Ages and hit the bell. New episodes drop every week. The ancients spent centuries learning these lessons. We are bringing them to you in 10 minutes. Do not miss the next one.